For the past 30 years, the global financial system has been powered by a single trade. A trade so large, so invisible, that most investors have never even heard of it. It didn't start in Washington. It didn't start on Wall Street. It started in Tokyo. And for decades, this one mechanism quietly pumped trillions of dollars into global markets, fueling the rise of tech stocks, the housing booms, cheap corporate debt, and the greatest asset bubble in modern history. But now that machine is starting to break, and if it does, it won't just affect Japan, it will affect everything. Stocks, housing, credit markets, and the cost of money across the entire world. Because the real risk to global markets right now is not AI. It's not inflation. And it's not geopolitics. The real risk is something far more boring. Something hiding inside the bond market. And almost nobody is paying attention. The story begins in the 1990s. To understand this story, we have to rewind 3 decades. Back to Japan in the early 1990s. At the time, Japan looked unstoppable. Its economy was exploding. Real estate prices were soaring. The stock market was breaking records. At one point, the land under Tokyo's Imperial Palace was supposedly worth more than all the real estate in California. Then the bubble burst. Hard. Stocks collapsed. Property values crashed. And Japan entered what economists later called the lost decades. For nearly 30 years, Japan's economy barely grew. Inflation disappeared. Wages stagnated. And economic momentum simply vanished. It was as if the entire economy had been frozen in time. Facing this economic stagnation, the Bank of Japan did something radical. They pushed interest rates to zero. Then below zero. And when even that wasn't enough, they introduced something called yield curve control, which essentially meant the central bank would cap long-term interest rates. No matter what the market wanted. They would buy unlimited government bonds to keep yields near zero. For decades, Japanese government bonds paid almost nothing, which created a massive problem for Japanese investors. Because if you're a pension fund, insurance company, or bank, you need returns. And when your government bonds pay zero, you only have 2 options. Accept no return, or look somewhere else. Japan chose option 2. Over the next 30 years, the Japanese capital flooded the world. Japanese institutions began buying foreign assets at an unprecedented scale. They bought U.S. Treasury bonds, mortgage-backed securities, corporate debt, European assets, emerging market bonds. Slowly but surely, Japan became the world's largest creditor nation. In simple terms, Japan became the world's ATM. Money flowed out of Japan and into global markets. But the real engine behind this phenomenon wasn't just investing. It was something much bigger. A trade known as the yen carry trade. The yen carry trade was brilliantly simple. Investors would borrow money in Japanese yen at extremely low interest rates, then convert that money into another currency, usually US dollars, and invest it into assets that paid higher returns. For example, an investor borrows money in Japan at 0%, then buys US Treasury bonds yielding 4%. After hedging currency risk and paying costs, they keep the difference. That spread becomes profit. And when borrowing costs are nearly zero, that trade becomes incredibly attractive. But investors didn't just buy bonds. They bought anything with a higher return. Tech stocks, real estate, corporate credit, emerging market assets. If it yielded more than Japan, it became a target. Over time, this strategy exploded in size. Trillions of dollars flowed through the carry trade. It became one of the largest sources of liquidity in the global financial system. Markets began to depend on it. Stock rallies were fueled by it. Credit booms were amplified by it. Asset prices rose because of it. The world was effectively running on cheap Japanese money. It was like the entire global financial system was connected to a giant liquidity hose. And Japan was holding the nozzle. For 30 years, that nozzle stayed wide open. But every system built on cheap money has one weakness. It only works as long as money stays cheap. In 2024, something changed. For the first time in nearly 2 decades, the Bank of Japan began raising interest rates. They also ended their yield curve control policy, which meant Japanese bond yields were finally allowed to rise. And almost immediately, markets reacted. Japan's stock market suffered its largest drop since 1987. Global markets became volatile, and investors began to realize something unsettling. The math behind the carry trade was changing. Because when Japanese yields rise, borrowing in yen becomes more expensive, and hedging currency risk becomes more expensive too. Suddenly, the free money trade wasn't so free anymore. Once the carry trade becomes less profitable, the incentives shift. Investors begin unwinding positions. Assets purchased with borrowed yen get sold, and the money starts flowing back to Japan. This process is called capital repatriation, and it can have enormous consequences. Because when trillions of dollars begin revering direction, markets feel it. Liquidity tightens, asset prices become unstable, and the cost of capital begins rising everywhere. But there's one market where this shift matters more than anywhere else: the US bond market. The United States government runs enormous deficits. Every year, the Treasury must issue trillions of dollars of new debt. That debt has to be purchased by someone. For decades, foreign investors were major buyers, and Japan was one of the biggest. Japanese institutions consistently bought US Treasuries, not because they loved America, but because the yield difference made sense. That demand helped keep long-term interest rates low. But if Japan reduces those purchases, the supply-demand balance changes. And when demand for bonds falls, yields rise. Most people believe the Federal Reserve controls interest rates. But that's only partially true. The Fed mainly controls short-term rates. The long end of the yield curve is driven largely by market forces. Supply and demand determine long-term yields, and those yields matter enormously. Because the 10-year Treasury yield acts as the foundation for pricing nearly every asset in the economy. Mortgage rates depend on it. Corporate borrowing costs depend on it. Stock valuations depend on it. Even venture capital funding depends on it. It's the baseline cost of money. Change that number, and everything else moves with it. The hidden impact on housing. Take housing for example. Mortgage rates are closely linked to long-term Treasury yields. If those yields remain elevated, mortgage rates stay high, which means housing affordability remains strained. Refinancing slows, home sales decline, and the entire real estate market cools. That's why many people expected mortgage rates to fall when the Fed began talking about rate cuts. But they didn't fall as much as expected, because long-term yields weren't cooperating. And one reason for that could be weakening foreign demand for US debt. Stocks face a similar problem. When investors value companies, they discount future cash flows using long-term interest rates. Higher yields mean future earnings are worth less today, which compresses valuations. Even if companies continue growing, the price investors are willing to pay declines. That's how you can have a situation where corporate profits look strong, but stock markets still struggle, because the cost of capital has changed. Then there's corporate debt. During the era of cheap money in 2020 and 2021, companies borrowed aggressively. Debt issuance exploded. Businesses refinanced loans at ultra-low rates. Private equity deals flourished. Venture capital funding surged. Cheap money created an explosion of financial activity. But if borrowing costs stay elevated, the opposite happens. Deals slow down. Risk appetite fades. Investment declines. Economic growth becomes harder to sustain. Because credit is the bloodstream of the corporate world. And when borrowing becomes expensive, the entire system slows. For 30 years, the global financial system benefited from one extraordinary advantage: Japan's ultra-low interest rates. That cheap money quietly flowed into global markets and supported asset prices. But that era may be ending. If Japanese yields continue rising, and the carry trade continues unwinding, then the world could lose one of its largest sources of liquidity. And when liquidity disappears, markets become fragile, volatility increases, and financial conditions tighten, even if central banks try to ease policy. This is why the biggest risks in markets are often the ones nobody talks about. They're not loud, they don't trend on social media, and they rarely dominate headlines. Because they're complex, they're technical, and they require patience to understand. But hidden beneath the surface of the financial system, structural forces are shifting, and those shifts can reshape the entire global economy. Because when the cost of money changes, everything changes. Stocks, real estate, credit, and global growth itself. The real question now is simple. For 30 years, the global financial system quietly ran on one hidden engine: cheap Japanese money. It fueled stock market rallies. It inflated housing markets. And it made borrowing across the world unbelievably cheap. But that engine is now starting to slow down. And if the yen carry trade continues to unwind, trillions of dollars of global liquidity could disappear. Which means the era of easy money may finally be coming to an end. Because when the cost of money changes, everything changes. Stocks, housing, credit markets, and the stability of the global economy itself. But the real question is whether this trade will unwind. The real question is something far more uncomfortable. For 30 years, Japan helped finance the global economy. But if Japan stops, who replaces it? Because if nobody does, the financial system may soon discover something it hasn't experienced in decades: a world without cheap liquidity. And when that happens, markets don't just slow down, they break. If you want to understand the hidden forces shaping the global economy, the ones most media outlets never explain, make sure you subscribe. Because the biggest risks in markets are rarely the loud ones. They're the ones hiding in plain sight.